All right, I think we're live here. Just gonna wait a little bit to have my let's see here. Let me get this situation. I need to replug my headphones here. Wait for some more people to join in on the call. There we go. Let's see how we're doing here. Got about 5 people in. All right, perfect. Let me know if my audio is okay. Sometimes it gets a little weird. But anyways, we will have the Disney call starts at 1:30 and the Airbnb call starts around 2 p.m. They're always a little late though. Let's hop over and see if they've released their report yet. Looks like Disney has not. We're gonna look at Airbnb here though and see if they have. Let's check in here though. Let's see. Aftermarket. Still waiting for this. And again, it starts at 2 p.m. here. Now, right now, we have the market doing all right. It's mixed up from yesterday's crash. Yesterday we had a pretty detrimental day throughout the market. And that's partially due to inflation. We can go ahead and take a look at some charts here while we're waiting for people to release earnings. We also have the Taiwanese stock exchange. If you look at the world stock market here, we have the Taiwan stock crash, and that's reflecting on the rest of the world as well. A lot of geopolitical stuff going on. And as I talked about yesterday, let me go ahead and find the charts here. We have the consumer price index changing as well. But one of the biggest parts right now that's going on, it's affecting the entire stock market as a whole. Oops, let's turn that off. Gross. There we go. We have food prices soaring right now, as well as lumber prices. And let's take a look at lumber prices here. Lumber prices at an all-time high. Gonna get rid of that here. And a little wonky. And so we just have a lot going on throughout the entire world and all the markets right now. Let me go ahead and get this situated here. I need another monitor. It'd be a lot better. I'm still waiting to see if Airbnb and as well as Disney for them to release their earnings report, and then we'll have the call later. The Disney call starts at 1:30 and the Airbnb call starts at 2 p.m. We have the lumber prices here, and you can tell that it's just really all over the place right now. I mean, if we go to, let's see if we can change this to the past month here. You can really see, let's go to the past 25 years. You can see lumber prices an all-time high for the past 25 years. And that's really just partially due to the lumber shortage, but also due to inflation. If we look at used car trends, which I know you might be wondering why the heck I'm looking at used car prices, but this has to do with inflation as well. And that's really what's affecting the stock market. On top of that, we have a sell-off due to the tax situation. So May 17th now is the tax extension. So we're having a lot of people sell their stocks to get that depreciation tax write-off. And that's what a lot of people are doing, as well as the Biden capital gains tax encourage more people to do that as well. So we have a broad just market sell-off in general. Although today we did see a slight recovery throughout the stock market. Tesla down about 3% here. And let's move on and see if they've released the earnings yet. We can go ahead and refresh this. No, it doesn't look like it yet for Disney. Let's check out Airbnb. They're always late with this kind of stuff, so maybe it'll be more like 1:15. It doesn't look like either of them have it yet, sadly. Well, let's see. Let's see if they've released the letter yet. Nope. They have not released the letter. This is for Q4 2020, so still got to wait. Should be any minute now. They'll release the shareholder letter, and then we can go ahead and take a look at the we can take a listen into the call as well. And I'll mute my mic for the call, of course. Don't want to ramble on during that. If you haven't been to one of these lives, what are my thoughts on Airbnb? So I actually made a video on Airbnb a little while ago. And sorry, I'm just going to leave this up here for people to watch. But yeah, Airbnb, it's an overvalued company, to say the least. And let's actually go ahead and go to Hypercharts and look up Airbnb here. But they have a huge situation on their hands. And, one of the biggest problems with Airbnb is the fact that their value was just it's just a hot stock, such a hot company, especially with retail investors, that their price just shot through the moon. And if you look at this, we have nights experiences booked here. I'm on hypercharts.co. Yes, they are increasing, but we just don't have enough data for me to be confident. And the other thing is they had a huge loss in revenue and operating income. But what we notice here is they said they're going to lay off workers. They said they're going to try to, decrease their spending. But if you go down to operating expenses here, you can see it just dramatically increase. Now, let me make sure you guys can really see this here. There we go. That's better. That should be a lot better there. Sometimes it cuts stuff off. But their operating expenses increased dramatically, especially in general administrative. So general administrative, Disney released? Okay, let's go ahead and hop into that then. Thank you for letting me know. I don't see it on here. Maybe I'm in the wrong spot. I want to find this. Let's go straight to investor relations here. Events and presentation. We have the results webcast. Let's see. I just want the actual letter though. Where is it? I don't see it on here anywhere. I do not see it yet. I don't know if they fully released it. Sometimes it comes out late. Let's check for Airbnbs as well. I don't see theirs either, unless I'm missing it completely here. Oh, here we go. What's this? Nope, that's the same thing. Dang it. Still waiting then. All right. I mean, unless I go straight to the SEC website, I guess. I could go right in here. We go to filings. We can go directly to it. Maybe they filed it here before they posted it on their website. Let's check for Disney here. I don't. Oh, here we go. You're right. Awesome. They did. They released their 8K here, but they just haven't released the slide deck or anything. So we're going to have a more boring look at this. Oh, no, they didn't release it yet. Yeah, never mind. Thought they did. Still got to wait for that, I guess. We'll see here. Any moment that they should come out. Usually they're pretty good. Oh, here we go. Perfect. They're out right now. Awesome. We can go dive into the earnings report here. All right. Let's see if I can go. No, I can't go full screen. Whatever. That's okay. Alrighty here. Let me just make sure you guys can see it all great. Yep, it looks good. Perfect. Let's go ahead and dive into this. It's going to be really interesting. Yeah, Yahoo published it. They also published it right on their investor relations site. So let's dive into Disney's first, since Disney's earnings call is the one that's at 1:30, whereas Airbnb's is at 2 o'clock. And, personally, I care more about the Airbnb call just because I think that them showing an increase in people traveling or increase in that can reflect like the broader economy and how it's doing as a whole. That's just my opinion. Now, I am an investor in Disney, however, so I also want to listen to that. So Walt Disney, they reported earnings for its second fiscal quarter that ended April 3rd, 2021. Their EPS increased to 50 cents from 26 from the prior year quarter. Diluted EPS increased 32% to 79 cents from 60 cents. Let's see what else here. Let's keep going on. We have revenues of about $15 billion. All right, that's a decline year over year, but that's expected. I mean, we have a decline of about 13%. It's completely expected here. Let's see the segment results. Let's dive in here. Let's look a little more. We have income. All right, down actually significantly up from last year. That's good. I know the parks and everything got going, but I really want to see about Disney Plus here is what I'm really interesting, because Netflix, they had a lag in a lot. You want Airbnb? All right. I can check on Airbnb as well here if they released it. Although I'm not seeing it on Airbnb's direct website. Let's look at the press releases. Here it is. No? I don't see Airbnb's on here right now. Unless we can go straight to... I just have to go straight through the SEC website or something again. Let's check the quarterly results here. Oh, here we go. Q1 2021. Perfect. Boom. Nope. Still haven't released it. Damn it. That's a big bummer. I really want to see that. Maybe it'll come out at like 1:15. Sometimes they're a little late. Still waiting for the shareholder letter. I really want to read through it. Any minute now. Oh, perfect. Here's the press release. Awesome. And we also have the shareholder letter right here. All right, let's look through this. So nights and experiences booked increased to... Okay, $64.4 million, or million, not dollars, sorry, but $10.3 billion in gross booking value. That increased 52% year over year. On top of that, we have revenue, which increased 5% year over year to $887 million, with a net loss of $1.1 billion. That's my problem with Airbnb. It's valued so highly. I mean, let's just go to Airbnb really quickly. I mean, it's valued at $82 billion right now. $82 billion. And they lost $1 billion this quarter, and they also lost money the previous quarter. That's my big problem. And on top of that, they have a decent amount, like $500 million in cash on hand. And I'll see if that's increased or decreased. But their financial situation just does, I think the market cap just does not reflect their, very interesting financial situation and the overall economy's financial situation as well. The unemployment rate's still around 6%, which is insanely high. So, there's still a broader economy that completely directly affects Airbnb. The only good thing for Airbnb that might justify its market cap, I would say, is the fact that so many hotels have closed, which means it has taken so much more of the market share, even though it was already taking market share from the entire industry there. All right, with the rollout of vaccines and the easing of some travel restrictions, our business significantly improved in Q1 2021 compared to the same period a year ago. People's desire to travel, combined with our tightly managed expenses, drove a return to positive top-line growth with materially improved adjusted EBITDA, earnings before interest, taxes, depreciation, and amortization. Here's a snapshot of the Q1 2021 performance. So Q1 2021 revenue increased 5% year over year and exceeded Q1 2019 levels, despite still being in a pandemic. And several significant items impacted Q1 2021 net loss. We kind of already know what that is. Obviously, their entire operations were pretty much shut down. So the significant items totaling $782 million, most of which were not related to our day-to-day operations. I really want to know about their expenses and why their expenses increased so dramatically. They consisted of a $377 million loss related to the repayment of term loans, $292 million for mark-to-market adjustment for warrants associated with the term loan, and $113 million impairment related to office space in San Francisco. That's never a good sign. We also recorded $229 million of stock-based compensation expense during the quarter. That's my problem with this company. That's one of my biggest problems. They lost $1.2 billion. They're valued at $80 billion. They go public when the company's in a financial distress, and then they have $229 million of stock-based compensation, which most likely went straight to executives at the company. That bothers me. They lost $1.2 billion and they're giving out massive compensation packages. Let's look at the adjusted EBITDA here. It materially improved due to a reduction in operating expenses. That's good. I guess their operating expenses slightly reduced. That's due to variable cost improvements, increased marketing efficiency, and disciplined fixed cost management. All operating expense line items were down from Q1 2020. Business highlights: they had a strong financial results in Q1 2021. They were driven by a number of positive business trends that we believe will sustain as travel recovers. Here are some of the key highlights from the quarter. So people are ready to travel. Yeah, the vaccine's been significant. They said actually, for summer travel increased by more than 60%. I believe that. I'm going, to a lot of places this summer, and I know a lot of people that are, and I think throughout the world, you have lots of things. On top of that, the UK. So immediately after British Prime Minister Boris Johnson, he announced plans to exit the lockdown in February. That's great. On top of that, you have the United States. Tons of different states are open right now. If we just go ahead, we can look at the map of the United States here. U.S. states open. We can go ahead and just take a look here. And this directly affects Airbnb, whether states are open. So we have the majority of them open right now. We have, let's see what else. We have some that are going to open soon. We have some that haven't really said anything, but they are also kind of open or semi-open. So we have June or later, California, Ohio. That's great. I mean, tons of them are open, though, which is awesome. So that's going to mean, if we look at the mask mandates as well here, the map kind of similarly reflects it, although it's slightly different. You can see which states are still very strict about that or not, which may prevent people from traveling to certain states. But as long as states are open to travel, that's going to be very good for Airbnb overall. Let's keep looking through this. So Airbnb supports the new ways that people want to travel. Yeah. A lot of this is just kind of stuff trying to make investors happy. That's why I'm skipping through so much of it. What I really want to see is their guidance and the overall numbers here. So let's see, 2021 plan. Their priority is to prepare for the coming travel rebound. To do this, we're perfecting our existing product, not an exit product, by improving the entire end-to-end experience of our core service for both hosts and guests. We're focused on the following areas. They're focused on educating the world about what makes Airbnb different, blah, 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 just a bunch of, you know how the talk goes on here. Let's keep going through here. I really want to see their guidance. Where is it? Let's see. For new listings that were both activated and booked in Q1 2021, 50% has received a reservation within 4 days. That's good. So 50% of their hosts are women, 58% of super hosts are women. Nice and diverse for Airbnb there. Okay, this is a story this is a really weird shareholder letter. I mean, they have a full-blown story from one of their customers. It's like they're really just trying to market Airbnb to me. $10.3 billion in their gross booking value to increase 52% year over year. 64.5 million nights and experiences booked. That's 13% growth year over year. In Q1, they delivered, we just said that. Let's see what else here. They've been affected and impacted by COVID-19, of course. On a regional basis, North America has been their strongest region during the pandemic. No surprise there. I really want to see more of their guidance here. Let's see if they have anything else or if they have their just the full press release. Nah, dang it. It's kind of a interesting shareholder letter here. $887 million in revenue with a $1.172 billion loss. Holy crap. I mean, this company's worth $80 billion, and they lost $1 billion this quarter, and they also lost money, significant amount, last quarter. Let's look at here. We got their quarterly revenue since 2019. No surprise it's not drastically increasing, although I do expect it to drastically increase the next couple quarters, primarily due to the fact that Airbnb, primarily due to the fact that just so many people are going to be traveling. So many people need to rent Airbnbs and have them booked out, but just, they have some deposits down, etc. But Airbnb won't collect that revenue really until after their stay or during their stay. Their quarterly net loss continuing to increase. Good God, Airbnb down to $1.1 billion. Been losing money for the past 3 quarters for an $80 billion company. This is definitely concerning. On an EBITDA basis as well, this is on an adjusted basis. See that revenue decline 7%. Good God, man. That's insane. Operating expenses in 2021, including the impact of a 229 stop. The stock-based compensation expense definitely bothers me a little bit, but the cost of revenue declined 8% year over year. That's due to lower infrastructure spend by efficiency gains and cost containment efforts, as well as lower chargeback expenses. Operations and support costs for Q1 2021 decreased by 16% year over year to $185 million. Product development expenses for Q1 increased by 40% year over year to $336 million, primarily due to the impact of stock-based compensation. That's excluding the impact of stock-based compensation. Product development expense fell 7% year over year to $219 million, primarily due to lower payroll costs as a result of a lower average headcount in our product and engineering organizations stemming from their global workforce reduction, which is interesting because last quarter there increased general and administrative expenses overall. They had a drastic increase in that, but they're laying people off. And I'm not sure if that's because of they have to pay some workers' compensation insurance type stuff. And when you lay people off, it also costs the company itself money, but not that much. So I'd like to have a more explanation for that. Yeah, see, general and administrative. Okay, so they talk about layoffs here. And then general administrative expenses increase 107% to 190 million. So you're laying people off, which should be cutting G&A, but instead it increases by over 100%. I thought you were laying people off, not hiring a whole army. I mean, to 190 million in general and administrative expenses alone. Remember that this company lost $1 billion and they increased their general administrative expenses despite laying off and reducing their workforce. I mean, geez, I don't know. We could definitely see how Airbnb stock is reacting after hours right now. Well, it's up about 0.9%. It took an immediate dip of 4% and then went up about 0.9%. It's probably going to stay like this or around even. I don't see Airbnb. This isn't like, there's no amazing news in this except for kind of what I already expected. They're basically saying, okay, the Airbnb is going to, we're going to do great this coming quarter in the summer due to increased travel. But we already know that. I want to see farther out. When is the company actually going to start making money? That's my question. How are they going to be able to cut their expenses? Why on earth are they reducing? Why on earth is they're reducing their labor force, but their G&A expenses continuing to increase? The net proceeds from the offering. They made $1.9 billion from the offering. That's great, though. That's going to put them in at least a more healthy position to pay off debt. Yeah, the extinguishment of debt of $337 million. That's good for the overall health of the companies, though. Especially, I wonder how much cash on hand they have. Let's see. Okay, here's the outlook. Finally, we get to the guidance. All right, awesome. They're proud of our strong recent performance driven by ability to adapt the ways people have been traveling during the pandemic, including rural markets, domestic travel, blah, blah, blah. In the near term, we anticipate year-over-year comparisons for night and experiences booked and GBV will continue to be volatile, unreliable measures of the steady state growth of our business. This is due to significant increases in cancellations that we experienced in Q2 2020 and changes in the historically more predictable booking patterns. So they expect for nights and experiences booked, Q2 2021 will be significantly higher than the highly depressed levels of Q2 2020, but below that of Q2 2019. We expect GB gross booking value in Q2 2021 to be higher than that of Q2 2019. Given the increase in ADR we have experienced since the pandemic began, for April, we've seen improving trends related to March in both nights and experiences booked. Again, how investors are reacting to this, in my opinion, the stock kind of reflects that right now. And yeah, this guidance is better, and that's probably why we're seeing the stock starting to rebound after hours, after its initial plunge, because the initial news was not very good. This guidance is making me feel a little bit better, although it's still not making me feel amazing about the overall company. We expect revenue in Q2 2021 to be significantly higher than that of Q2 2020. Well, here we go. That's a good sign, given the impact of COVID-19 on the prior year. We expect positive momentum of recovery experienced in Q1 2021 to be partially offset by the continued uncertainty of travel restrictions and lockdown. The overall pace of the early stages of the travel recovery and the improvement it has driven in our business have been rapid or relatively rapid. In fact, the pace of recovery in Q1 and Q2 to date has exceeded our initial expectations. That's a good sign. That's what investors want to hear, because as the overall economy and travel economy start to continue, that's going to directly affect Airbnb's business. Especially the good thing about Airbnb right now is that there's been so many hotel closures. Airbnb's competition is almost non-existent right now. I mean, Airbnb can really thrive this coming summer and going into the future as its competition is, closing down. Let me take a sip of my coffee here. So this guidance is all right, and we can see how the stock is reacting here once again. Up about what is this? Up about 1.5%. Let's keep moving on here, though. The earnings call for Disney does start in 1:30, so I do want to hop over and take a look at Disney since we're almost done with the Airbnb shareholder letter. Their EBITDA margins will be lower in the first half of Q 2021 than the second half, both due to seasonally and investment. Okay, that's seasonality, I see. And to investments we are making in certain areas. In Q2 2021, we expect that our adjusted EBITDA margin will be at break even to slightly positive. Well, that's good news. God damn, it's about time. Consistent with last quarter, we expect that sales and marketing expenses as a percentage of revenue in the first half of 2021 will be higher than that of the second half, partially due to the marketing campaign that we were running in the first half of 2021 in advance of the summer travel season. That's good. I know they cut their marketing significantly over this year, so by increasing their marketing now, they're going to, again, just completely outdo their competition. And that's it for the Airbnb little shareholder letter. That was a really interesting letter. They really made it quite confusing. We can take a look at the consolidated balance sheet here and go over the quarterly summary here. Nights and Experiences book. We already took a look at that. Let's look at the consolidated statement of operations, though. So revenue it actually increased from 2020, which is fantastic. Obviously 2020, their operations completely got shut down during this time. So it's kind of obvious it increased, but that shows a great sign that the company is beginning to recover. We see loss from operations increased to $446 million. And general administrative increased to $189 million from $91 million, despite laying off so many workers. That to me is so confusing. They cut sales and marketing, which is, I think that's good. Since people couldn't travel, might as well cut sales and marketing. But now they can start to ramp that up for this next quarter. We have product development increasing to $336 million. That's okay. They had to do a lot of stuff with redesigning their site to actually redirect people and, I guess, recommend places to stay that are more in rural places and away from large city or dense gathering areas due to COVID-19. So I'm not surprised that took a lot to revamp their entire website, a lot of the code as well. Not surprised for a product development increase there. Operations and support decreased. That's great, to $185 million. But again, the general administrative expenses is what bothers me the most here. Although I know a lot of it might do to some increase in compensation. Restructuring charges, $111 million. Well, when you go public, you're gonna have to restructure a lot. No surprise there. Interest income decreased. Their net loss increased to $1.1 billion. Their net loss increased to $1.1 billion, guys. This is an $80 billion company, and they lost $1 billion this quarter. In one quarter, they lost over $1 billion. And last quarter, they lost $340 million. And the craziest thing is, I guess it's been during the lockdown this quarter still, but states have begun to recover. I feel like people are going back and starting to stay at Airbnbs more. I'd expect their loss to be less this quarter, or at least even with 2021, but instead of a year-over-year basis, we have over 100% increase in net loss. I mean, that's insane. This company's financial situation is pretty dire here. At least maybe their consolidated balance sheet will give us more hope here. Their cash position also decreased, good lord, to $4.4 billion, but they did have to do quite a bit of spending this year just to keep their company afloat while their business was entirely shut down. But still, their net loss needs to start decreasing this next quarter. If I see their net loss be anything significant last quarter, that's going to give me a big red flag. We have current assets here, or let's go ahead and just look through here. Cash and cash equivalents decreased to $4.4 billion. Much of that cash is still from the cash that they received due to their IPO last year. We have restricted cash of $19 million. Total current assets increased to $10.9 billion, which is great, primarily due to the funds receivable and amounts held on behalf of customers, which they're counting as assets, which is kind of interesting. On top of that, you have property and equipment, decreased to $210 million. That's great that they're cutting some of their office space down, most likely. We have goodwill here. It's slightly decreased, but pretty much even. Not a big deal there. But overall, their total assets increased to $12.3 billion. Let's see if their shareholders' equity increased overall as well. stockholders' equity increased to 3.1 billion. So for the overall health of the company, their balance sheet is looking relatively healthy despite a slightly decreasing cash position. But that's not too concerning to me. The bigger concern to me is the fact that they lost a $1.1 billion and they're valued. If they were valued at, say, just a few billion, then I'd be more positive on this company. But their valuation is pretty high. I'd see how the stock is reacting as well. The stock is up just 0.01%, pretty much even right now. And that's how I feel. I think the stock is it's reflecting exactly how I feel and probably how a lot of other investors feel as well. Now, I know the Disney call is starting soon, so we could hop into that. I do want to listen to that, and I do want to look through some of Disney's stuff here. And what I really want to look through, if we can find it here, just cute. Yeah, there we go. Sweet. I'm going to just hop over to the Disney one. I've looked through most of Airbnb's stuff. Let's see if we missed anything besides them losing over $1 billion this quarter. Although their current asset or their stockholders' equity increased, which is great. Other than that, I'm just trying to scan through and see if I see anything really alarming or anything super important here. But yeah, I think the stock's reflecting exactly how me and other investors feel about the company right now. We know what's going to happen in the future. We know travel is recovering. We just want to see what happens. And that's kind of why I'm just watching this company, but I'm not getting directly involved. Because the problem is the value of this company is so high for what it's doing. It's losing tons of money, but it's valued at over $80 billion. I mean, that's pretty wild. I know that's not too rare these days with companies. But again, I need to see Airbnb's business really start to recover, not continuing to decrease. Let's move on. Let's try to see if we can see the revenues here from the good thing for Disney, if we go here and touch on Disney a little bit, is that their parks are really opening back up, which is starting to, I think that's definitely going to increase their bottom line. Obviously, it's down from 2020 slightly, 44% decrease there. We had an increase of 1% in their media and entertainment distribution sector. And that's on a quarterly basis, though. 6 months ended at 2% decrease, however. I really want to find their... Oh, here we go. Perfect. All right. Here's the millions of paid subscribers for Disney+. Disney Plus is at 103.6 million paid subscribers as of this quarter. God damn, that's great. An over 100% increase since the year over year. I mean, that's impressive. We also had an increase on ESPN Plus. A lot of this was driven by COVID year over year. Let's hop into the call here and see if it started or not. And I'll mute my mic once the call starts. There might be some really bad music playing here.
With the ongoing rollout of the
vaccine, no, we're good. All right, I'll shut up.
Gradual lifting government-mandated restrictions. And through this time, we've taken advantage of the opportunity to make improvements to our operating procedures to enhance the guest experience through the use of technology innovations, new ticketing strategies, and other offerings. We are especially excited that after being closed for 412 days, we welcomed our first guest back to Disneyland 2 weeks ago, and the response has been overwhelmingly positive. Bob and I stood on Main Street, USA on opening day, and it was so wonderful to see the joy on our cast and guest faces and feel the excitement in the air. It's been fantastic to see cast members back at work. Most recently at Disneyland, we were able to quickly recall more than 10,000 furloughed cast and retrain them to be able to operate to the state of California's new health and safety requirements. We continue to see strong growing demand from consumers as we are at or near our reduced capacity levels at both Walt Disney World and Disneyland for the current quarter. It's clear our guests are excited to get back to experiencing the magic of Disney, and they also have extraordinary confidence in our safety protocols. At Shanghai Disney Resort, where they just kicked off their year-long 5th anniversary celebration, the park is operating at or above FY19 levels. We're also encouraged by what we're seeing at Hong Kong Disneyland, and we are hopeful we will be able to announce a reopening date for Disneyland Paris soon. Despite the pandemic, we continue to make progress on a number of highly anticipated projects at our parks around the world, including the all-new Avengers Campus, which is set to open at Disney California Adventure on June 4th. I had a chance to visit it recently, and the attractions and multiple state-of-the-art experiences are truly phenomenal. We recently unveiled our newest cruise ship, the Disney Wish, to the public with a virtual live stream presentation that has been viewed nearly 1.2 million times. The ship is amazing, and it includes the Aqua Mouse water ride, the first ever Disney attraction at sea. The Disney Wish will set sail on its maiden voyage in 2022, and bookings open to the general public on May 27th. On the studio side, we are pleased to be nearing full production levels, and we are also significantly ramping up content creation at our studios, consistent with the guidance we provided at Investor Day. An example of this is 20th Century and Searchlight Pictures, where they are gradually increasing output and will reach a steady state of 15 and 20 films respectively to fuel our general entertainment offerings across all of our distribution platforms. We're incredibly proud that Searchlight's Nomadland took home Oscars for Best Actress, Best Director, with Chloe Zhao becoming the first woman of color to win the award, and Best Picture. That's 5 Best Picture wins since 2009 and 43 Academy Awards in total. Additionally, Pixar's stellar record of award-winning films continues with the studio's animated masterpiece, Soul, which took home Oscars for Best Animated Feature and Best Original Score. And I'm happy to say that now millions are able to enjoy Soul on Disney Plus and Nomadland on Hulu. As we have consistently stated, flexibility is a key component of our distribution strategy, and we have outlined 3 approaches for distributing our films: releases in theaters with a simultaneous offering via Disney Plus Premier Access, releases straight to Disney Plus, and traditional exclusive theatrical releases. Here's how this translates to our tremendous upcoming film slate. Cruella will be released in theaters and via Disney Plus Premier Access on May 28th, followed by Pixar's Luca, which will be released exclusively on Disney Plus on June 18th. The highly anticipated Black Widow will be in theaters and on Disney Plus via Premier Access on July 9th, and Disney's Jungle Cruise, a hilarious adventure-filled expedition, will be available in theaters and on Disney Plus via Premier Access on July 30th. I'm pleased to announce today that amidst recent signs of increased consumer confidence in moviegoing, 2 films, 20th Century's exciting comedy, Free Guy, and Marvel's action-adventure, Shang-Chi and the Legend of the Ten Rings, will be released with a 45-day exclusive theatrical window on August 13th and September 3rd, respectively. And of course, regardless of where they originate, all of our films and episodic series will end up as part of the robust library of content on our DTC platforms. Like our films, our Disney Plus original series have become must-watch events, starting with the success of The Mandalorian, followed by Marvel's WandaVision and The Falcon and the Winter Soldier. These not only became immediate hits, but part of the cultural zeitgeist, and the anticipation for Marvel's newest series, Loki, which debuts on June 9th, has been through the roof. The second season of High School Musical, the series, the all-new The Mysterious Benedict Society, based on the popular young adult book series, and the animated series Monsters at Work are also coming to Disney Plus in the next couple of months, just to name a few. We are uniquely positioned with the most compelling brands and franchises in entertainment, and we continue to deliver the high-quality, one-of-a-kind content that consumers want. That's clearly reflected in the success of Disney Plus, which amassed nearly 104 million paid subscribers as of the end of the second fiscal quarter. We are on track to achieve our guidance of 230 to 260 million subscribers by the end of fiscal 2024. Looking at our entire portfolio of streaming services, we expect that as full production levels resume and we get to a more normalized cycle, the increased output will help fuel additional sub growth across Disney Plus, ESPN Plus, Hulu, and Hotstar. Hulu and ESPN Plus had 41.6 million and 13.8 million paid subscribers respectively at the end of the quarter. On Hulu, buzzworthy content continues to boost performance, including the award-winning Hulu original film, The United States versus Billie Holiday, and Season 4 of The Handmaid's Tale, which premiered to the biggest audience ever for a Hulu original. And there's lots more coming to Hulu, including Marvel's new animated series, MODOK, Season 2 of the hit series Love, Victor, and Season 10 of the wildly popular anthology American Horror Story on FX on Hulu. In March, we launched ESPN Plus on Hulu, and we are very pleased with its early progress. Viewers who subscribe to both Hulu and ESPN Plus are able to watch and engage with the great content that's available on ESPN Plus without leaving the Hulu environment. ESPN Plus programming includes thousands of live sporting events, original shows, series, and documentaries, with the UFC lightweight championship fight airing live on ESPN Plus pay-per-view on May 15th. The final match of the FA Cup also on May 15th, followed by the PGA Championship, Wimbledon, and the highly anticipated third UFC matchup between Dustin Poirier and Conor McGregor on pay-per-view July 10th. Not to mention the incredible additions to our lineup, including NHL and more college football in the fall. Live sports are a very important component of our content business, and even amidst the challenges of the past year, we have continued to build our unrivaled portfolio of sports rights in a disciplined way. While our overall strategy is still very supportive of our linear business, given the important economic value it drives for the company, we are also building out our ESPN Plus direct-to-consumer offering. And with every deal we make, we are considering both the linear and DTC components. With this strategy in mind, we've reached a number of long-term accretive deals that each play a very specific role as part of our sports portfolio. Some are weighted more towards linear with a significant digital component, such as the NFL and SEC deals, others reflecting an emphasis on direct-to-consumer. These include agreements with the UFC, the PGA Tour, Bundesliga, and the NHL. For example, as part of the 7-year rights deal with the NHL, 75 of the league's live national games will be available exclusively on ESPN Plus and Hulu. And ESPN Plus will be the sole home for more than 1,000 out-of-market NHL games, further cementing the service as a must-have for hockey fans. And today, I'm excited to announce 2 additional sports rights deals. We've reached a renewal deal through 2028 with Major League Baseball, with 30 exclusive regular season games, which include 25 Sunday night baseball games and opening night annually. Coverage of the highly anticipated potential expanded wildcard series, and the option to simulcast all live MLB coverage from ESPN networks on ESPN+. We've also signed a historic rights agreement with the top division in Spanish club football, La Liga. La Liga is one of the world's best and most popular soccer leagues, including a number of the top clubs in the world and one of the best players in the world, Lionel Messi. And this 8-year deal, covering both English and Spanish language rights, brings 380 La Liga matches and a host of La Liga 2 matches per season to ESPN Plus, beginning in August. And this deal bolsters ESPN Plus's position as a top destination for soccer in the U.S., offering fans more than 2,900 matches per season. When you combine the unparalleled assets of the Walt Disney Company, ESPN, ESPN Plus, ABC, and Hulu, plus our highly engaging digital and social content, it's clear that Disney is the absolute leader when it comes to serving our sports fans in the most effective way possible. We believe in the power of live sports and are confident our multi-platform rights deals we've made will provide us tremendous value now and into the future. Overall, we are pleased with the encouraging signs of recovery across our businesses, and we are confident we continue to move in the right direction for our future growth. And with that, I'll now turn it over to Christine, and she'll talk more in depth about our results for the quarter.
Thank you, Bob, and good afternoon, everyone. Excluding certain items, diluted earnings per share for the second fiscal quarter increased 32% versus the prior year to 79 cents per share. We are beginning to see progress in many of our businesses after more than a year of adverse impacts from the pandemic. While we are not out of the woods yet, we are pleased with our results this quarter at both our DMED and DPEP businesses. I'll walk through our results by segments, starting with Media and Entertainment Distribution. Operating income at the segment increased by 74% in the second quarter versus the prior year due to higher results across all of the segment's lines of business. At Linear Networks, the increase was driven by growth at both our domestic and international channels. At domestic channels, both cable and broadcasting operating income increased versus the prior year. Higher results at cable were driven by lower programming and production costs and higher affiliate revenue, partially offset by lower advertising revenue. ESPN's results were in line with the guidance we gave last quarter, and ESPN was the most significant contributor to cable's growth this quarter. The decrease in programming and production costs was largely due to the timing of the college football playoffs. As we mentioned last quarter, fiscal Q2 included only one CFP bowl game, the National Championship, compared to 4 in the prior year quarter, 3 CFP bowl games, and the National Championship game. Cable programming and production costs also benefited in the quarter from lower production costs for other live sporting events and lower programming costs at Freeform. Lower advertising revenue at cable was primarily due to lower average viewership. At ESPN, domestic advertising revenue decreased significantly in the quarter, driven by lower ratings for key programming in addition to the timing of the college football playoffs. Quarter to date, domestic advertising revenue at ESPN is currently pacing up significantly versus last year, benefiting from the prior year's lack of significant live sports programming due to COVID. At broadcasting, higher results were driven by growth at ABC, partially offset by a decrease at the owned television stations. At ABC, lower programming and production costs and higher affiliate revenue were partially offset by lower advertising revenue. Programming and production costs were impacted by the shift in timing of the Academy Awards, which took place in the third quarter this year compared to the second quarter last year. Lower advertising revenue was primarily driven by lower average viewership and the timing of the Academy Awards, partially offset by higher rates. On our Q1 earnings call, we said we expected the Academy Awards timing shift and lower political advertising at our owned stations would negatively impact broadcasting results in the second quarter versus the prior year. While we did see those specific adverse impacts play out, overall broadcasting results were higher than we expected, driven by lower marketing spend due to timing shifts of some new series, in addition to a number of other smaller factors. Total domestic affiliate revenue increased 5% in the quarter. This was driven by a benefit of 8 points of growth from higher rates, offset by a 4-point decline due to a decrease in subscribers. Operating results at international channels increased due to a decrease in programming and production costs and an increase in advertising revenue, partially offset by lower affiliate revenue. Lower programming and production costs in the second quarter were driven by a higher percentage of content cost being allocated to our DTC business rather than our networks business as we continue the international expansion of Disney Plus and Star, in addition to channel closures over the past year. Advertising revenue increased primarily due to the timing of BCCI cricket matches, which generally take place in the first quarter, but were in the second quarter this year due to COVID-related timing shifts. Lower affiliate revenue at our international channels was due to channel closures as well as an unfavorable foreign currency impact. At our direct-to-consumer businesses, operating results in the quarter improved by over $500 million versus the prior year due to stronger results at Hulu and ESPN+. The increase at Hulu was due to subscriber revenue growth and higher advertising revenue, partially offset by higher programming and production costs related to the Hulu Live TV service. Hulu ended the second quarter with 41.6 million paid subscribers, up from 39.4 million in Q1, inclusive of the Hulu Live digital MVPD service. Paid subscribers to Hulu Live declined modestly to 3.8 million from 4 million at the end of Q1, which we attribute primarily to the $10 price increase we took in December, in addition to a modest impact from seasonality. At ESPN+, improved year-over-year results were driven by subscriber growth and an increase from UFC pay-per-view events. ESPN Plus had 13.8 million paid subscribers as of the end of the quarter. At Disney Plus, results were comparable to the prior year quarter, as an increase in subscribers was largely offset by higher content, marketing, and technology costs. As Bob mentioned earlier, we had almost 104 million Disney Plus paid subscribers at the end of the second quarter. At our annual meeting, we announced we had reached 100 million global paid subscribers. We reached that milestone in early March, so we added subs at a faster pace in the last month of the second quarter than we did in the first 2 months. And that was despite no major market launches, a price increase in EMEA, and a domestic price increase toward the end of the quarter. We attribute this success to the strength of our overall content slate, the launch of the Star General Entertainment offering in many markets, and the continued growth of Disney Plus Hotstar. Between Q1 and Q2, Disney Plus Hotstar was the strongest contributor to net subscriber additions, making up approximately a third of the total Disney Plus subscriber base as of the end of the second quarter. However, ARPU at Disney Plus Hotstar was down significantly versus the first quarter due to lower advertising revenue as a result of the timing of IPL cricket matches and the impact of COVID in India. As a reminder, the majority of the prior IPL tournament took place in fiscal Q1, and there were no games in Q2. The current IPL tournament began on April 9th in fiscal Q3 and was suspended last week given the COVID situation in India. Disney Plus's overall ARPU this quarter was $3.99. Excluding Disney Plus Hotstar, it was $5.61. As we move through the remainder of the year, we should start to see the benefit on Disney Plus ARPU from price increases we've taken around the world. Last quarter, we guided to second quarter direct-to-consumer operating income improving modestly versus the prior year. Actual results came in significantly better versus the prior year due to Hulu advertising sales upside, lower content and marketing expense at Hulu and Disney Plus, and better than expected ESPN Plus pay-per-view results. Content sales, licensing, and other operating income at DMED increased in the second quarter versus the prior year due to higher TV SVOD results and lower content impairments, partially offset by lower home entertainment results. Higher TV SVOD results were primarily due to an increase in income from sales of episodic content, driven by sales of more profitable programs in the current period and lower write-offs. This was partially offset by a decrease in sales of film content. The decrease in home entertainment results was driven by the absence of significant title releases in Q2. Moving on to our Parks, Experiences, and Products segment. DPEP's operating income in the second quarter decreased by $1.2 billion year over year, as growth at Consumer Products was more than offset by lower results at Parks and Experiences due to the impacts of COVID-19. At Consumer Products, growth in operating income was due to increases at our merchandise and games licensing businesses. At Parks and Experiences, results were again adversely affected by COVID-19 related closures and reduced operating capacities versus the prior year. Disneyland Resort, Disneyland Paris, and our cruise business were closed for all of the second quarter, whereas these businesses closed in mid-March of the prior year quarter. Hong Kong Disneyland Resort was opened for approximately 30 days during the second quarter, compared to approximately 25 days in the prior year quarter. Walt Disney World Resort and Shanghai Disney Resort were both open for all of Q2. In the prior year quarter, Disney World closed in mid-March and Shanghai closed in late January. Our parks and resorts that were open during the quarter operated at significantly reduced capacities, yet all achieved the objective of a net positive contribution, meaning that revenue exceeded the variable costs associated with opening. At Walt Disney World, attendance trends continued to steadily improve throughout the second quarter, and guest spending per capita again grew by double digits versus the prior year. Disneyland Resort reopened on April 30th, and as Bob mentioned earlier, we are very encouraged by the initial guest response. Forward-looking bookings for park reservations at both of our domestic parks are strong, demonstrating the strength of our brands as well as growing travel optimism as case counts decline, vaccine distribution ramps, and government restrictions loosen. Looking ahead, there are a couple of items I would like to mention. At Linear Networks, we expect a significant decline in operating income year over year in the third quarter, largely due to higher sports programming and production costs at ESPN, which we expect to increase by $1.2 billion versus prior year. This year's Q3 includes marquee events such as the NBA, Major League Baseball, the Masters, Wimbledon, and the European Football Championship, which compares to Q3 of last year, during which we had a limited slate of events due to COVID. At our direct-to-consumer business, we now plan to launch Star Plus, our standalone general entertainment and sports streaming service for Latin America, on August 31st. Moving the launch to late summer allows us to leverage a strong sports calendar, which includes the return of European soccer leagues, including La Liga and the Premier League, championship games for the Copa Libertadores, the prominent regional international soccer competition, along with Grand Slam tennis. As Bob mentioned earlier, we remain right on track to reach our fiscal 2024 guidance of 230 to 260 million subs, powered by the addition of 30 million paid Disney Plus subs in the first half of the year. And notwithstanding our expectation for fewer net sub adds in the second half of the year, given the COVID-related suspension of the IPL season, and our decision to move the Star Plus Latin America launch to the fourth quarter, we remain very optimistic about our future. And with that, I'll now turn the call back over to Lowell, and we would be happy to take your questions.
Okay, thanks, Christine. And, as we transition to the Q&A, let me note once again that since we are not all physically together this afternoon, I will do my best to moderate by directing your questions to the appropriate executive. And with that, operator, we are ready for the first question.
Thank you. As a reminder, if you would like to ask a question, press star, then the 1 key on your touchtone telephone. Our first question comes from Ben Swinburne with Morgan Stanley. Your line is open.
Thanks. Good afternoon. Maybe just starting on the direct-to-consumer side, for Bob, could you talk a little bit about how the price increases have landed relative to your expectations, both internationally with Star, but also in the U.S., kind of the impact on churn and how that might inform your decision-making process going forward on price? And then I just wanted to ask, I think you guys generated maybe $700 million or so of free cash flow in the quarter. Normally, we don't talk a lot about quarterly free cash flow, but it's been a while. I'm just wondering, Christine, if you think at this point, we're back in free cash flow positive mode going forward and expect to generate free cash flow for the year. Thank you both.
Okay, Ben, thanks for the questions. Bob, you'll take the first one on price response, and then Christine, you'll take the cash flow question.
All right. Of course, these were our first price increases since we launched. I have to say that we're extremely pleased with how the market reacted to both.
We'll make brief opening remarks and then spend the remainder of the time on Q&A. Before I turn it over to Brian, I'd like to remind everyone that we'll be making forward-looking statements on this call that involve a number of risks and uncertainties. Actual results may differ materially from those expressed or implied in the forward-looking statements due to a variety of factors. These factors are described under forward-looking statements in our shareholder letter and in our Form 10-K filed with the SEC on February 26, 2021. We urge you to consider these factors and remind you that we undertake no obligation to update the information contained on this call to reflect subsequent events or circumstances. You should be aware that these statements should be considered estimates only and are not a guarantee of future performance. Also, during this call, we will discuss some non-GAAP financial measures. We provided reconciliations to the most directly comparable GAAP financial measures in the shareholder letter posted to our investor relations website. These non-GAAP measures are not intended to be a substitute for our GAAP results. And with that, I'll pass the call to Brian.
All right. Thank you very much, Ian, and thank you, everyone, for joining us today. I want to start by acknowledging the state of the pandemic. COVID-19 cases continue to surge in parts of the world, such as India, and our thoughts go out to our hosts, guests, and employees in India during this difficult time. There's much more work to do to limit the spread of the pandemic, and many people are still hurting. And we know how lucky we are to be in the position we're in today. 2020 was a year that none of us will ever forget. It was also a year when travel fundamentally changed forever. Airbnb changed as well. We sharpened our focus on our core business of hosting, and we got back to our roots, back to what is truly special about Airbnb, the everyday people who host their homes and offer experiences. And we emerged as a stronger and more efficient company. Our business rebounded faster than anyone expected, and it showed that as the world changes, we are able to adapt. Now turning to our Q1 results. Our business dramatically improved with the rollout of vaccines and the easing of some travel restrictions. While conditions aren't yet normal, they are improving. People's desire to travel, combined with our tightly managed expenses, drove a return to our positive top-line growth with materially improved adjusted EBITDA. In Q1, our revenue was $887 million. This was an increase of 5% year over year, and it exceeded Q1 2019 levels as well. But here's the most important fact. Our business improved without the recovery of two of our strongest historical segments, urban travel and cross-border travel. We expect the return of urban and cross-border travel to be significant tailwinds over the coming quarters. Now, as our top line recovers, we are maintaining our focus and our financial discipline to improve our profitability. Our adjusted EBITDA loss was $59 million. This was approximately $190 million better than the same period in 2019, and it was $275 million better than a year ago on essentially the same revenue. Now, these results show that we are improving our variable cost. We're being disciplined with our marketing and our fixed costs. Our strong performance also indicates the beginning of the travel rebound. Just a few hours ago, the director of the Centers for Disease Control said, quote, "If you are fully vaccinated, you can start doing the things that you had stopped doing because of the pandemic," end quote. What we think this means is that more people will be comfortable traveling. And it further strengthens our view that we are going to see a significant travel rebound. In fact, we expect this rebound to be unlike anything that we have ever seen before. And we expect travel to be very different than before. People are discovering that they don't have to be tethered to one location to live and work. And what this means is that people are more flexible about where and when they travel. People can now travel anytime. People are also traveling everywhere. They're not just going to the same 20 or 30 cities. They're visiting smaller cities, towns, and rural communities. And when people do travel, they're staying longer. 24% of our nights booked in Q1 were for stays of 28 nights or longer. People are not just traveling on Airbnb, they're now living on Airbnb. And these trends are not going away. The world is never going back to the way it was, and that means that travel is never going back to the way it was either. So let me tell you about what we're doing to prepare for what's ahead. Our single priority in 2021 is to prepare for the coming travel rebound. To do this, we're perfecting the end-to-end experience of our core service. This includes educating the world about hosting, recruiting more hosts, simplifying the guest experience, and delivering a world-class service. Now I'm going to briefly share how we're executing against each of these areas. First, we are educating the world about what makes Airbnb different: hosting. In late February, we launched our first large-scale marketing campaign in 5 years, made possible by Host. We're educating guests about the benefits of being hosted, and we're inspiring more people to become hosts. Now, while it's still early, the campaign is being well received. In markets where we're running the campaign, overall traffic is up, first-time bookers are up, traffic from prospective hosts is up, and our brand favorability is up. Second, we are recruiting more hosts, and we are setting them up for success. To build on the momentum of our marketing campaign, we launched an accompanying digital campaign that's focused on recruiting new hosts. And we've completely redesigned the end-to-end experience of being a host on Airbnb. We're making it easier for anyone to start hosting. Third, we are simplifying every part of the guest experience. In February, we launched a flexible dates feature. It allows guests to browse options while being flexible on the exact dates of their trip. Now, since the feature launched, there have been more than 90 million flexible date searches on Airbnb. 90 million searches since just February with flexible dates, this new feature we created. And guests who use this feature have converted at a higher rate than guests who do not. Now, this is just one of many improvements that we are making to the guest experience. And finally, whenever our guests or hosts need us, we must deliver world-class service. So to prepare for the travel rebound, we're improving our community support products, enhancing our safety protocols, and we're scaling our operations by ramping our third-party support. Now, I want to wrap by highlighting a major announcement that we have coming up in less than 2 weeks. On May 24th, we will announce the most comprehensive update to the Airbnb service in 12 years. As part of this special announcement, we're going to share insights on how travel is fundamentally changing, along with the updates we've made to prepare for what's ahead. We're going to unveil a simpler and more inspiring guest experience, and we are going to show you upgrades that make it even easier to be a host on Airbnb. So to watch the announcement, visit Airbnb.com on Monday, May 24th. So to summarize, we're pleased with the strong Q1 results. We are encouraged by the trends that we're seeing driving these results, and we are executing against our 2021 plan to prepare for the travel rebound. And we think this travel rebound will be unlike anything we've seen before. We think this is a travel rebound of the century. So travel is coming back, and Airbnb is ready. And with that, Dave and I look forward to answering your questions.
At this time, I would like to remind everyone, in order to ask a question, press star and the number 1 on your telephone keypad. And your first question comes from Justin Post with Bank of America.
Great. Thanks so much for taking my question. I guess I really want to focus on behavior change, which could benefit the company, first hosts and also guests. I think in the letter it said host listings were stable with Q4, but it seems like you're really encouraged by what you're seeing. So maybe you could dive in there and tell us, what is encouraging about what you're seeing with hosts and whether you expect a lot of new listings to hit the market over the next year. And then similarly on the guest side, how do you think this pandemic is going to increase willingness to use alternative accommodations? Are you seeing some positive signs there? Thank you.
Thank you very much, Justin. So why don't I start, and Dave, feel free to add in after I go. So let's start with hosts, and then we'll go to guests. So Justin, let's just start with, we have 4 million hosts on Airbnb. And I think if you asked people a year ago, would we have had such a stable host community, they probably wouldn't have expected that. But what we have today are hosts that offer 5.6 million listings. And these 5.6 million listings are about 1 million more than we had this time in 2019. And what we've actually seen is a large growth in non-urban listings. So we actually have a 30% growth in non-urban and vacation rental listings as well. Now, it's important to note that 90% of our hosts are everyday people, they're individuals. And the reason why is as we've made hosting on Airbnb easier, more and more hosts are coming to Airbnb as well. Now, specific to what we're doing, we launched our first global campaign in 5 years, made possible by hosts. As I said, we also have an accompanying host campaign. Both of these campaigns, we are seeing significantly larger traffic of prospective hosts to the platform. The next thing we're doing is we're making it even easier to become a host by reducing the number of steps to become a host. And as we reduce the number of steps, conversion rate for hosts gets even easier. We now are allowing hosts to be paired with other superhosts to help them get started, and we have webinars as well. And then finally, we have new tools and services that are going to make it even easier for hosts to list and be successful. I'll just end this first thing by saying on May 24th, we will unveil a number of new tools and services I think are going to make it much easier for hosts to get started. And I want to point out that new hosts that join Airbnb, 50% of them get a booking within 4 days of activation. And I think hosting is coming at the perfect time for many people in the world. Because Airbnb, we started actually after the Great Recession in 2008. And at that time, there were many hosts, many people that were looking at Airbnb as a financial lifeline. I think if you think about the number of hosts on Airbnb, the top occupations of our hosts are healthcare workers, educators, and people in food and hospitality. These are industries that have been hit really, really hard. So our job is to tell the story of hosting, the fact that on an Airbnb, you can make $8,000 United States on average if you have one listing, which is 5 times you can make what an average American got in a stimulus check. So these are some of the things we're getting going, and we are just getting started ramping, and I expect us to get millions of more hosts in the coming years on Airbnb. Now, as far as trends for guests, Justin, I'll also cover this as well. As I said before, I think 2 things are true. Number 1, this is a travel rebound that is starting that is unlike anything we've ever seen before. And I think the Q1 results kind of demonstrate this. But the other thing that we're seeing is that travel is going to be very different than before. Probably the biggest changes are the following. Number 1, I don't think business travel is ever coming back the way it was before the pandemic. It's at least not going to look like it did. I do think a new kind of business travel may emerge. Many employees are working remotely. They're going to need to go back to headquarters occasionally. You're going to see longer stays going in cities. And so we're seeing elevated bookings in urban markets for stays of longer than 28 days. But the bigger trend is going to be flexibility. I think that all of us working around the world, most of us, if we're privileged enough to say this, are more flexible than we were before the pandemic. Because of a world of Zoom means a world where we can work anywhere, is a world where many people are also choosing to live anywhere. And this has created 3 travel trends. Number 1, people can travel anytime. This is why we have a flexible dates feature where instead of saying, I want to travel from July 5th to July 10th, you can say, I want to go somewhere for a weekend, a week, or a month, anytime this summer. We've had over 90 million people use this feature. And as more people use this feature, conversion rate goes up. The second thing we're seeing is length of stay is increasing. In 2019, at this period of time, 14% of our nights were longer than 28 days. Now, 24% of our nights are longer than 28 days. What that basically means is a quarter of our business isn't travel, it's living. After 28 days, you're probably not traveling. And I think what this is a trend of is that traveling and living are going to begin to blur together. So this is the second trend we're seeing. And the third is people are now traveling everywhere. If you look at the concentration of our revenue, it is much more distributed than it was a couple years ago. And this is because people aren't just going to the same 20 or 30 cities. They are getting in cars and they're traveling to small towns, rural communities, many of which don't even have a hotel. So again, the big trend is flexibility. People are traveling anytime, anywhere, and they're staying longer. We think all these trends are here to stay. And I'll just end by giving one more thought. I think there's a mass shift from mass travel to meaningful travel because people miss traveling. In fact, in many surveys, people say the thing they miss the most that was taken away from the pandemic, at least from out-of-door activities, is travel. But they don't miss business travel. They don't miss standing in a line in front of a museum or a selfie, a landmark, getting a selfie stick, getting a photo with a selfie stick. What they really miss is spending time with the people they care about. And we call this meaningful travel. We are friends and family. We think Airbnb is really a great way to do that. So those are the trends that we're seeing. The two trends I do think are going to inverse are we are going to see a recovery of urban travel and a recovery of cross-border. This has been our bread and butter before the pandemic, and I think those are significant tailwinds for us.
Great. Thanks for that very detailed answer. Appreciate it.
And your next question comes from Mario Lu with Barclays.
Great. Thanks for taking the questions. The first one's on listings counts. So you said you have similar levels to last quarter, around 5.6 million. But with this hosting campaign that you guys are running, is there like a timeline that we should expect to drive that number up? Or, you mentioned in the past that a quarter of guests eventually become hosts. When should we expect that number to increase?
Yes, Dave, why don't I give you this question? And it's a great question, Mario. And I'll also say that in Q1, 28% of our hosts were now prior guests as well. So that number is increasing. But Dave, I'll hand it over to you.
Yeah, to be clear on the stat, it's that of guests, 25% or 24% were former, new hosts were former guests. So just to be clear with the percentage. It's early. We're seeing strong listing count, 5.6 million. It's been very stable. I think actually one of the things that's been really impressive during this time is that our host churn in Q1 21 is actually lower than our host churn in the same period in 2019. And actually our churn in 2020 was even lower than what it was in 2019. So I just think it all just shows kind of the resiliency and the stability of our supply. And we're just optimistic that as things continue to rebound, as we continue to educate people about the benefits of hosting and all of the tailwinds that Brian just outlined, we'll continue to see a strong host growth going forward.
Great. And just one follow-up on domestic versus international. So I'm not sure if you can see this in your data yet, but just curious to hear if you've seen some substitution in terms of domestic bookings versus international as the vaccine rates increase. And do you think the domestic rates, will remain above 2019 levels even after borders open up? Thanks.
Yeah, Dave, do you want to take this one as well?
Yeah, I mean, it's unclear exactly where everything will settle out for domestic versus international. Clearly, right now, 80% of our nights in Q1 were domestic. So we've seen domestic travel being consistently the strength all around the world. Historically, our strength has obviously been in urban areas and cross-border. So prior to kind of the pandemic, I think about 50% of our nights were actually cross-border nights. And obviously, with that not occurring, clearly there's going to be some substitution where people are going to stay domestically where they might have taken a cross-border trip. But again, our urban cross-border has been our strength. We know that many of these trips will be are incremental and such that when travel rebounds to a more typical state, we'll have growth in overall travel just due to the hesitancy, right? People are hesitant to travel right now if they aren't vaccinated or maybe even can't travel due to some of the lockdowns on borders. So we know that many of the trips will be coming back and will be incremental to what we're seeing today.
Great. Thank you.
And your next question comes from Colin Sebastian with Baird.
Thanks. Good afternoon. I have a couple of questions on investments and spending. I guess first off, what gives you the confidence that you can moderate sales and marketing spend in the second half without impacting bookings or listing levels, if that's still the plan? And then in terms of product development, obviously Brian will be making some announcements soon, but how are you thinking about the pace of R&D or product development spend now that business appears to be returning to normal or whatever normal means now? Is it perhaps time to look at reaccelerating hiring or what are your thoughts on that? Thank you.
Yeah, thank you very much, Colin. Dave, why don't I take this at a high level and you can obviously go into more detailed analysis. So, Colin, a couple things. Let me just first start and talk about our marketing strategy, and then I'll answer your very specific question about H2 marketing. First of all, we take a very different approach to sales and marketing, I think, than our competition. What we have is a full funnel integrated approach to marketing. And what we integrate is PR, brand marketing, and performance marketing. And really, PR, in addition to word of mouth, is the thing that really built our brand over the last 10 years. And because of that, Airbnb is a noun and a verb used all over the world. And this has led to 90% of our traffic being unpaid or direct, even as recently as Q1. And even in this past quarter, with elevated marketing, we have similar traffic levels to 2019, but we spent 50% less on marketing. So we think that if you have a product that is unique and different, that the role of marketing isn't to buy customers, and the role of marketing is not sizzle. The role of marketing is education. And so what we have done is we did our first brand marketing campaign at a global level in 5 years. It was a campaign called Made Possible by Host, and it's really just taking real photos from real guests on real trips to highlight what makes Airbnb different, which is host. We want our host to be as mainstream as the homes and spaces on Airbnb. Now, while the results are still early, as I said, we have seen elevated traffic levels. And to answer your question on H1 versus H2, we decided to front load spending. We were prepared for a travel rebound unlike any other, so we didn't want to spread the money over the course of the year. So we disproportionately put the spending in H1 to really capture as much of this demand as possible. And I think what we're seeing is that timing is going to bear out to be the right timing. And then as far as why don't I also answer product development at a high level, and then Dave, you can also go in. So at a high level for product development, here's what we've learned. Before the pandemic, we were a divisional structure. We had our core business of homes. We also had a business travel. We were working on a number of other divisions. We had many divisions. And because we had many divisions, we had multiple product development groups. And what we did is when we became a functional organization and we got much more focused on hosting, we realized that we could be much, much more efficient. It's one of the reasons our product development group is much smaller than it was 2 years ago. And that's allowed us to move really, really fast. And I hope that you see on May 24th that even despite the team being smaller and more nimble, we've been able to increase the pace of development. I think people are going to be really impressed by what we're able to deliver. So that's at a high level. But Dave, I don't know if you want to jump in and talk more specifically about the numbers.
Yeah, I mean, our product development spend will increase at a lower rate than revenue. We're not going to have to add back significant number of fixed resources in order to accommodate the business that's back to the size of 2019 and beyond. So we're just going to be very disciplined in any additions to our expenses. And then, as Brian said, we're just seeing great success with our marketing strategy, which we actually started modifying prior to COVID, solidified during COVID, and are continuing to see strength here in Q1. So marketing as a percentage of revenue will be higher in this first half of the year than it will be in the second half of the year. But we're very encouraged by the results.
Great. Thank you.
And your next question comes from Naved Khan with Truist Securities.
Yeah, thanks a lot. Brian, maybe give us your thoughts about the reopening of urban travel in terms of timing. How are you thinking about it? Is that something that you think might happen in the back half of this year, or you think that's further out?
Yeah, thank you very much, Naved, for the question. Well, let me preface my answer with 2 comments. Number one, I'll try to be careful with predictions because anyone that was in the business of making predictions last year tumbled. The second thing I'll say is no matter what happens with travel, I think one of the things we showed last year is that our model is inherently adaptable. And so we are adaptable to any travel changes. But that being said, I do think we have quite a bit of data. And so with the data we have and we're seeing, I think I can give you some indications, although it's going to be a little hard to pinpoint. We are seeing that as restrictions lift and cross-border begins, more people travel to cities. We're also seeing that the nature of travel to cities is changing. For example, more and more people are booking longer-term stays in cities, so the length of stay is going up. And one of the things we know is that the longer you stay somewhere, the more you're inclined to stay in a home. So I think that as restrictions lift in countries, as vaccinations rise, we think this is a significant tailwind to both urban travel and cross-border travel. So we're very, very bullish. It's a little hard to pinpoint, but I think the comments from the head of CDC today, the lifting of restrictions across Europe, these are all really, really good signs. There's no reason this wouldn't be a huge tailwind to urban travel and cross-border.
Yeah, our urban travel growth rate has increased every month this year and continues to do so through April and early May. So we're just seeing continued positive momentum.
Thanks. That's very helpful. And maybe a quick follow-up, if I may. So Brian, you talked about business travel maybe becoming a little different, where people might just travel to headquarters and maybe rent, maybe on Airbnb. Do you see a good opportunity to maybe take share in the segment versus previously just targeting business travelers going into cities?
Yeah, I mean, in New York City, in Los Angeles, a number of these cities, we almost have as many nights booked for stays longer than 28 days as we do stays under 28 days. In New York City, actually, the majority is over 28 days now. So I think that there's a huge opportunity. If you think about where business travel is going in the future, it seems completely intuitive to me that as companies offer more flexibility, more people are going to live around the world, but they're not all going to want to live remote. They're going to have to come back to visit. And so I think you're going to start to see longer stays. I think in addition to longer stays, you may also see business travelers traveling together. So let's say 3 different employees work in 3 different cities and they have to come back to headquarters. They may not all get 3 different hotel rooms or Airbnbs. They might get one house. They can split the costs. They can eat around the breakfast table in the morning. So I think the things that benefit Airbnb of business travel is group travel and longer stay travel. Those 2 things I think are disproportionately beneficial to do in homes, and these are general tailwinds for business travel. Now I want to be clear, I mean, people will of course travel for business again. I just think the bar to get on a plane to go to a meeting will be higher than before.
Thank you.
And your next question comes from James Lee with Mizuho.
Great. Thanks for taking my question here. A couple questions regarding the supply side. And can you guys talk about maybe in supply and demand balance, by region a little bit here? Where do you see surpluses? Where do you see deficits? And are you also looking to increase your supply by tapping into professional hosts? I know 90% are individual, or even hotel supply. And also secondly, and what are the key frictions that you're seeing right now for your host signing up and that you're looking to address with these new tools you're about to introduce? Thanks.
Yeah, Dave, do you want to take supply and demand? I can probably take the increase in pro host and key frictions.
Sounds good. Yeah, I mean, on supply and demand, really what we're seeing, because cross-border and urban travel has not yet fully rebounded, the places that we're seeing surpluses or deficits in demand, where we have surplus of supply, would be more urban markets, and where we can see some tightening of it, especially U.S. non-urban, for the peak of the summer, is clearly going to be some of the most constrained of our markets. So we're actively, working against each of those areas, but on each side. On the supply side, making sure that we are doing our best to recruit hosts and bring on as much supply as possible for peak periods in constrained markets. And then we're also using, go back to our marketing expenses before, where we use search engine marketing is in targeted approach, especially in markets where we have maybe surplus supply and not maybe enough demand. And so we can kind of point it at that. So we look at every individual market is different, and we will use different levers to try to manage that balance over time.
Yeah, and James, why don't I jump in and say this? one of the things that Dave just said, I want to put highlight. Before the pandemic, most people came to Airbnb and they knew exactly where they were going and they knew when they were going. So we asked a question in search bar, where are you going? And we asked, when are you going? You put in dates. The holy grail for matching supply and demand is to be able to also control where you can point demand. But we can't point demand to where we have supply if guests aren't flexible, if they're predisposed to where they want to travel. Now that guests are telling us that they're much more flexible about where they travel, we can point demand to where we have supply. This is probably one of the most important things we have, and it explains why when 90 million searches were used with the flexible dates feature, conversion rate went up. So that is just another thing I wanted to underline. Now, regarding your next two questions, let's talk about pro hosts and hotels. Obviously, Airbnb created a new category in travel because we created tools that allowed everyday people and individuals to become hosts. And yes, out of 4 million hosts, 3.5 million are individuals. That being said, we welcome all hospitality providers on Airbnb. And we have hundreds of thousands of professional hosts and professional hospitality providers. The way we think about it is when a guest comes to Airbnb, they're looking for a place to stay. And so we don't want them to leave without having found something they want. Typically, they come to look for individual hosts. That's what we're known for. But we want to make sure that we have professional hosts and hotels to serve those customers and to fill in our network gaps. So we're continuing to develop new tools and services over the coming years to continue to welcome these providers onto our platform. And I think they're going to obviously benefit from all the demand that we have. Now, as far as key frictions to becoming a host, one of the things we've seen, probably the main learning we've had, is as you make it easier, more people do it. That's the name of the game. Make it easier, more people do it. Before Airbnb, it was really hard to rent, your home on the internet. People did it, which is hard, and we made it easier. And on May 24th, we're going to show a number of tools, a number of offerings and innovations that we have that are going to make hosting even easier. We're reducing the number of steps to become hosts. We're making it even easier by providing more tools and support, and we're going to offer some better tools and services for hosts once they become hosts. And so I think all these things will reduce the number of frictions as well.
If I can answer follow-up questions, also on the host side too, are you seeing increased competition for acquiring hosts and maybe potentially pressure on your take rate? Thanks.
Dave, do you want to take this one?
Sure. Right now, what we're seeing is, remember, kind of step back to what our hosts are. We have 4 million hosts around the world. The vast majority of those are individual hosts. So 3.5 million of those are individual hosts. And I think that's very different than what we see kind of competitive platforms are doing. And so, what we end up seeing with the 4 million hosts that we have is, give me the last part of the question. Sorry, I lost my train of thought.
Yeah, increased competition for hosts and maybe potentially pressure on take rates?
Yeah, no, the pressure on the take rate. Right now we're not seeing the pressure on take rate. We think that we have a really great value to the take rate that we give. We charge rates that give good value to both our guests and our hosts. And what we see on the take rate side is making sure that when we give value back to our hosts, that then we are able to take kind of appropriate revenue from that. So we're not really seeing any pressure at that driving for increasing or decreasing, the number of hosts that we have on Airbnb.
Okay, thank you.
As a reminder, please ask only one question so that we can accommodate as many analysts as possible. And your next question comes from Brian Nowak with Morgan Stanley.
Thanks for taking my questions. I have two. The first one is on the 2020 new users that you added. It was a great year to sort of add a lot of new users to the platform. Be curious to hear about what you're seeing from those new users from a retention or booking perspective now as you're into 2021, and how that compares to what you've seen in the user cohorts in the past. And the second one is to go a little bit more into the monetization of the take rate. Can you just talk to us about any of the tests or experiments you've been doing around insurance or ancillary service sales or tiered take rates or sponsored listings, and ways we can think about that take rate potentially adjusting over time for more services to your hosts or guests? Thanks.
Yeah, thank you very much, Brian. Dave, why don't I take the second question, monetization take rate, but why don't you take the question on new users? What are we seeing from new users from retention and booking?
Yeah, so what we're seeing for new users, it's early, but all of the early data for the new users that we've acquired here during 2020 is that the retention is very consistent with what we had for users in 2019 and before. So I think one of the benefits that we've seen in 2020 is just we've actually been able to lower the barrier for entry for new guests to kind of come to Airbnb and try us out for the first time. You don't have to hop on a plane. You don't have to go across a border. As we said, over 50% of our nights historically have been cross-border. You don't have to do that to try Airbnb. Now you can kind of drive just a couple hours down the road and go check us out. And what we're seeing from the early results is that the retention rates are very consistent with what we've seen in the past.
And then on, Brian, to your question about monetization and take rate, we absolutely see lots of opportunities to increase our monetization and take rate for both guest and host. For example, one of the things we've said is that many of the tools and services we've offered in the last 5 years, the incremental, we haven't charged for. For example, unlike our competitors, we offer free protection of $1 million against theft, property damage, and personal liability in countries all over the world. And as we added these services, we do not charge incrementally for these. Our general principle is we always want to give away more value than we're taking, but we do think there's opportunities for us to offer some more tools and services to increase take rate. Now, that being said, focus is critical, and we are focused on the most perishable opportunity. The most perishable opportunity right now is to capture as much travel demand as possible and be ready before anyone else is for this travel rebound. So we are making sure that we have enough hosts for this travel season. We simplified the guest experience, and we're providing world-class support. So that's what we're focused on this year, but make no mistake, we have many opportunities in the years ahead.
Great. Thank you both.
And your next question comes from Mark Mahaney with ISI.
Okay, I'll stick with one question. Just on the supply side, will you address the issue of whether increasing local restrictions is a factor that's limiting your supply especially in some of the larger cities? And I realize that travel hasn't really recovered there fully, but just address the issue of whether how much of a constraint new local regulations on rentals, et cetera, is on your ability to expand supply. Thanks a lot.
Yeah, I can take this at a high level. Dave, you can feel free to jump in as well. Mark, thanks for the question. What we saw with COVID was actually a positive reset in our relationship with cities all over the world. Now, first, let me just start by saying we now collect and remit taxes in 30,000 jurisdictions. We've collected and remitted to date $2.6 billion of transient occupancy taxes. What happened with COVID is two things. Number one, travel went from being concentrated in very few top cities to distributing everywhere, thousands of cities around the world. Though we do see an urban recovery, we don't see that trend completely reversing. Because I think in a sense, you could say the genie's out of the bottle. A number of people have realized that there's all these really cool small towns, rural communities, and small cities, many of which don't even have hotels. And so they're really important destinations. The other thing that we've noticed, though, is that a lot of cities have been hit really hard by the devastating economic effects of the pandemic. So you'll see major cities have had major tourism shortfalls, major tax shortfalls. And because of this, what we've actually seen is a lot of cities reaching out to us. In fact, we struck over 100 partnerships over the course of just the pandemic with destination marketing organizations, which, as you know, are basically tourism bureaus and tourism arms. From Scotland to Portland, we've been doing partnerships with cities all over the world. And to scale our partnerships to thousands of cities, we launched last year the City Portal as well. So this is what we're seeing. I don't know if you want to add anything to that.
I think that's key. We also added this new capability last year of the City Portal, which is another tool to enable cities to understand what goes on with our business in each of their communities. And we think that's been another positive tool for cities to feel like they can work with Airbnb to help their economies rebound.
Okay. Thanks, Brian. Thanks, David.
Thanks, Mark.
And your next question comes from Jed Kelly with Oppenheimer.
Hey, great. Thanks for taking my question. I guess, Brian, going back to business travel, I guess it's kind of like a two-part question. I guess number one would be, where are you in terms of talking to companies, talking to businesses, sort of, making the ability to work from anywhere through Airbnb a benefit. And then as like a follow-up, you mentioned work from anywhere. Your company's, of course, based in San Francisco. So how do you see basically potentially using the work from anywhere trends to sort of save costs to make your business more efficient if you can, have more employees working outside the Bay Area? Thank you.
Yeah, these are two really good questions. Let me start with the first one. So as you point out, and as I said, one of the trends that has been pretty remarkable over the last year is as more people have more flexibility, they can work from home, and that means they can work from any home, often on Airbnb. And so one of the things we're doing is we're continually trying to make it even easier for guests to be able to search anywhere around the world. And on May 24th, we're going to show you some new tools and new ways to make the experience of searching on Airbnb, especially allowing you to search with more flexibility, even easier. Again, the type of flexibility we're looking at is people staying longer, booking anytime, and be able to go anywhere, not just to the same top destination. So we are going to continue to look at innovation in this area. And I think the other thing I'll just point out is, again, in 2019, only 14% of our nights booked were longer than 28 days. That's now 24%. And so we think this is a huge growth area for us. We think basically a quarter of our business is not even travel anymore. There's a lot of innovation opportunities for us. We're a design-led company at our heart, and I think that we're going to offer a lot of really interesting opportunities. Now, specific to our San Francisco employee base, let me talk a little bit about what I told our employees a couple weeks ago. I told them there's two guiding principles. Number one, we want to model the live anywhere lifestyle. So by modeling live anywhere lifestyle, we're going to allow more flexibility for our employees. So I told our employees they don't have to come back to the office until next September. We're going to allow a lot of flexibility. And even when we do ask people to come back, they're going to have a lot more flexibility than before. People aren't going to be expected to come back to the office 5 days a week, every week. We think that is really not how most workplaces in the 21st century are going to operate. That being said, as a creatively led company, we also do think that in-person collaboration is important. So we want to find some balance between modeling the live anywhere lifestyle and allowing for in-person creative collaboration. And that's what we're designing. We want to get it right. We don't want to rush into this. So that's what we're going to be working on over the course of next year.
Thank you.
And your next question comes from Justin Patterson with KeyBank.
Great. Thank you very much. Ryan, just extending on the prior question, it does sound like this platform experience update is really designed around inspiration and discovery. Without spoiling your announcement on the 24th, I'm curious about how you think about the opportunity to broaden the funnel on Airbnb, provide inspiration for travelers as they think about places to stay and things to do, such that, Airbnb really starts to drive that initial inspiration and you just have a much broader spectrum of guests than before.
Thank you, Jess. It was a little bit hard for me to hear you, but I think the question was, what are we doing to drive more inspiration and discovery on Airbnb, inspiring where you can go and what you can do, correct? I just want to make sure I could hear the end of that last question. Okay, I'll answer that. So, so inspiration is something that we're really focused on. Actually, if you go to Airbnb.com right now, if you type in Airbnb.com, you're going to notice on our top of our homepage, there's a big piece of art and it says the greatest outdoors. So we just launched wish lists that are curated by Airbnb. And if you click on Get Inspired, you're going to see a number of wish lists. So this is just the beginning of a number of things we're doing to try to inspire more travel. On the homepage below that, you're going to see that we're now merchandising places you can go nearby. So between wish lists, nearby travel, and then some of the updates we have on May 24th, I think that's going to continue to drive more and more inspiration. On May 24th, though, we are going to showcase some new exciting features that I think are going to inspire people around flexibility. Because one of the things we've seen is if you are more flexible about where you travel and when you travel, then what that kind of means for some people is the home becomes the destination. Suddenly, where you go is less important than the type of home you stay in. And so, this is how we're thinking about it. And hopefully, if you can tune in, we can show you some of the things we're working on.
And your next question comes from Lloyd Walmsley with Deutsche Bank.
Thanks. Two questions, if I can. First, can you talk about how you think about occupancy rates or kind of room nights per active listing, over the medium term? It seems like it's been pretty stable over the past few years, but wondering if this notion of like blending of travel and living is kind of increasing shoulder season demand in a way where you can grow room nights in excess of listings or get more out of your existing listings. And then the second one, the average booking value per night looked really high in 1Q. If you peel back the onion and look within the same region, the same property type, are you seeing pricing up, or is most of this just mix shift? And how do you think about this as travel normalizes a bit? How would that impact ADRs going forward?
Great, Lloyd. So I'll take the first question, occupancy rates. Dave, you can take the second one.
Great.
The answer to your question is yes. Occupancy rates, we think, averaged on a global level will go up as we get better at matching supply and demand. The basic name of the game is in classic travel, a lot of people try to go to the same place on the same date. That's why kind of when you show up to Paris in the summer and there's a whole bunch of people in line at a landmark, it's because they're all going to the same place at the same time. So to increase occupancy rates, there's one of two things we can do. We can add more hosts to the same places that everyone's going to, or we can point demand to other places. And as length of stay increases, as people shift from going to 20 or 30 cities to thousands of communities, and as people become more flexible when they travel, we can then show them deals. We can show them, for example, I know you want to go to, we'll make up the place, France in July, but if you went in September, you could save a lot of money because there's fewer people there. Or we can point you, instead of in Paris, we can point you to Brittany or some other community. So there's a lot of opportunities for us, I think, to point demand to where we have available supply, which will allow us to steadily increase occupancy. So what it means is we don't need to increase supply linearly with increasing revenue. We can get more productivity out of the supply that we have. And Dave, I don't know if you want to take the ADR.
Yeah, and our ADRs in Q1 were up 35% year over year. That was after being up 13% year over year in Q4. The significant majority driver of the ADR increase is driven by mix. The rebound has been earlier in the U.S., which has a higher average daily rate. It's been in non-urban, whole home, and even larger homes, and each one of those is just on average a higher ADR. So the majority of the ADR that we're seeing is from mix. When we actually look at some highly constrained markets in a highly constrained time period, we're seeing some pricing pressure within there that will drive ADR rates up, but the vast majority of it is just driven by mix.
And the other thing I'll just say again is, another thing I'll just say is, as demand increases on Airbnb, that can also correspondingly increase supply. So again, one of the things we published in our S1 was 23% of our new available hosts in 2019 were guests. That increased to 28% of our new available hosts had started out as guests in Airbnb in 2020. So we also think there's a really interesting flywheel where we can point demand where we have supply. We have a muscle to continue to add hosts, but we can also convert guests to hosts. And as that number keeps increasing, that's another big lever for us.
Got it. Thank you.
And your next question comes from Brent Thill with Jefferies.
Dave, I don't know any color you can add around the final unlock that comes over the next week of, close to 500 million shares. I know not all of those are eligible, but is there any way you could just frame that? There's been some fear of this unlock and what it means. Can you just, any color around that you could give would be helpful.
Yeah, Dave, you want to take that?
Sure. So, we clearly our unlock comes on Monday, and the key thing that we're doing to try to make sure that we're ready for the unlock is to do what we've been doing, which is deliver outstanding results, deliver outsized kind of gross booking value, revenue, and driving for profitability. So there's not a lot more color I can give you on the unlock on Monday beyond that.
Okay. Thank you.
And your next question comes from Brian Fitzgerald with Wells Fargo.
Thank you, guys. We wanted to ask if you could tell us what you're seeing with respect to experiences, supply dynamics there, online versus offline, linkages to travel, conversion rates there, and anything with experiences.
Yeah, thank you very much for the question. So here's what I'd say about experiences. When we came back in the beginning of the year of 2020, I really thought Airbnb experiences would be a breakout year last year. It turns out a pandemic was a very difficult year for experiences. We had to put product on hold. We remain very, very bullish about experience over the long term. One of the reasons we remain bullish is because the percent of guests that leave a 5-star review with experiences is higher and remains higher than percent of guests that leave a 5-star review for homes. But the pandemic was a difficult time for experiences, so we launched online experiences, which is the way to have an experience without leaving your living room. And I am thinking that in the coming years, experiences will be successful because there's fewer alternatives. There's fewer mass tour operators, bars, lounges, and restaurants are going to be operating at full capacity. So we do think there's a window, but we're playing the long game on this one.
Thanks, Brian.
As a reminder, to ask a question, press star and the number 1 on your telephone keypad. And your next question comes from Stephen Ju with Credit Suisse.
Okay, thanks. So Brian, I asked the same question to one of your competitors last week, so I'd be interested in your opinion and what is probably more of a macro consideration. So the consumer savings rate, in at least the United States, is probably at the highest level it's been since World War II. And, it will take some time for all of this to widen down to, I guess, normalized levels, which brings up the scenario of consumer spend probably accelerating for the next several years. And hopefully, one of the likely destinations for all of these dollars is going to be in travel. So, I know it's early days of the recovery, but what are you seeing in terms of, I guess, a greater willingness to maybe, say, upgrade to the more expensive Airbnb or just in general stepping up in the frequency as we recover here? Thanks.
Very good question, Stephen. Let me tell you what we're seeing so far. One of the things is we did travel surveys in the beginning of the year, and we surveyed people in the United States. We also surveyed people around the world. And in our surveys, what we found is that the out-of-home activity people miss the most, more than restaurants, more than bars, more than sporting events, more than concerts, was travel. The kind of travel people missed was not business travel. It was not mass travel going to crowded destinations. It was really just spending time with people that they've not been able to see during the pandemic. I think that we generally just yearn for what was taken away from us, and travel and spending time with people was something that was taken away from us. Now, with regards to your question about are we seeing people upgrading, we have seen, as we mentioned, a material increase in the average daily rate in the United States. And this does give us a sense of consumer willingness to spend. Maybe another way of saying it is maybe before the pandemic, people were booking studio apartments in cities. Now what we're seeing is a pretty big expansion of people booking entire homes, typically even more bedrooms. The number of guests per reservation is increased considerably, and so correspondingly, people are spending more money. I think that trend, of course, will get normalized over some period of time when other geographies recover and urban recovers, but I do think that we are going to see sustained confidence. That's no question.
Thank you.
And your next question comes from Deepak Mathivanan with Wolfe Research.
Hey guys, thanks for taking the questions. Just a couple quick ones. So first, can you talk about the implications of booking window trends on second quarter and the second half? It feels like there's a lot of summer bookings happening right now already in markets like Europe and even in North America. Is that earlier than usual, or does that mean that the recovery is being pulled forward by some capacity? Just wondering if you can provide some insights on that. And then second question, not sure if this was asked already, how are you thinking about the ROI on the targeted digital marketing programs aimed at hosts? Are these on performance channels? Any color that you can add there would be great.
Yeah, Dave, why don't you take these two questions?
Sure. So regarding the booking window, we're seeing the booking window obviously in 2020 shrank dramatically, right? People were hesitant to travel. They only started booking when they had high confidence that they were going to travel. What we've seen here early in Q1 of 21 is the booking windows have expanded, and in March we actually saw booking windows consistent with those from March of 2019. So, the windows are expanding. I think that what you're seeing is still even more confidence in the U.S., so that the willingness of travel and the booking window in the U.S. has expanded further than it has in Europe. But we're starting to see some, greater acceleration of our European, business. We're seeing the European nights increasing the rate of year-over-year growth every month of the year since the beginning of the year, including through April and May. And, we're seeing that as things like the lockdowns in France are removed, and after the UK Prime Minister announced plans to exit lockdown in February, we started seeing more acceleration in Europe. So the booking window trends are positive and give us encouragement for what we're going to see in the back half of the year, but we'll just have to see what the lockdowns and other kind of travel restrictions look like for Europe for the back half. And then regarding the ROI on targeted digital marketing for hosts, this is one of the levers that we have. When we do targeted digital marketing for hosts, it would be in specific areas that we know are more supply constrained, and where we want to focus on it. We establish a return on that investment for the value of the hosts that we acquire through that channel. And it is one channel, but it's not the only one, and it's not the primary one. Again, the most important thing is to kind of step back and educate people about the benefits of hosting, and then make it easier for them to host once they start considering it.
Got it. Okay. Thanks, Dave.
And your next question comes from Kevin Kopelman with Cowen.
Great, thanks. A quick one. Could you give us an update on cancellation rate trends this year compared to 2019 with I think the average listing being a little bit more flexible than it was in the past? Thanks.
You're welcome. Dave, you want to take this one for Kevin?
Sure. So the cancellation rates obviously were substantially elevated in 2020 versus 2019. They've begun to moderate so that they are substantially below where they were at in 2020, but they're still moderately elevated versus the 2019 rates. So we're seeing a bit more return to normal, but it's not quite to historical normal rates.
Perfect. Thanks, Dave. Thanks, Brian.
Thank you.
And your next question comes from Tom White with D.A. Davidson.
Great. Thanks for taking my question. Just one for me. To follow up on ADRs and specifically your expectations for the second half, I know there's some color in the letter, but can you maybe unpack your thoughts on kind of all the different moving pieces there, between the recovery and some of the kind of structurally lower ADR markets, recovery in urban and cross-border? Just curious to hear your thoughts on how it all kind of nets out, you think, in the back half.
So thanks, Tom. Dave, I'll give you this one.
Sure. Yeah, I think that the best thing to do is actually kind of look at some of the guidance figures that we gave in the earnings call itself, where we're basically expecting, because it's harder to have visibility in the back half of the year. We're highly confident in the rebound, that it's going to be coming. All the early indications are that it's there, but I think it's hard to kind of precisely pin down what Q3 and Q4 are going to do. So what we did do is give some perspective on what we expect out of Q2. And that is that our gross booking value in Q2 of this year will be higher than in Q2 of 2019, and that our revenue rate in Q2 will be similar to that of 2019, and that our adjusted EBITDA will be break even to slightly positive in Q2 of this year. So I think those are kind of the key things, because as you said, as rebound comes back, the pace at which it comes back and the geographies that come back will all affect the mix of those ADRs, and we do expect the ADRs to moderate, but it's hard to perfectly pinpoint down, the specific of that mix.
Okay, thanks, guys.
I will now turn the call back over to the management team for closing remarks.
All right. Well, thank you, everyone, for joining us today. I just wanted to recap. We are really proud of our strong Q1 results. We believe they're a testament to our focus and the adaptability of our model. and we've shown over the past year that as the world changes, Airbnb can adapt. I think we're now well positioned for the travel rebound ahead. As travel returns, Airbnb will be ready, and our hosts will be ready as well. So I hope you'll join us on May 24th, where we'll share insights on how travel is fundamentally changing and announce the most comprehensive update to Airbnb service in 12 years. Thank you, and we'll see you then.
This concludes today's conference call. You may now disconnect.
All right, guys. Thanks for listening in. We listened to a lot of the Disney call, and we just finished listening to the Airbnb call. Airbnb trading up 1.47% after hours. That call made me significantly more bullish on the company's long-term outlook with how positive they were about travel returning to, travel going full steam ahead here in the coming months. So that made me much more positive and much more optimistic for the company. But anyways, I'm going to wind it down here. I'm getting kind of tired. I got to go get food. It's about 3 p.m. where I'm at right now. Thanks for listening in. Please subscribe for more stock market analysis videos, as well as investment analysis. Got some good ones coming, some future live streams as well. I don't do many of these live streams, but I really enjoy doing them kind of like off the cusp like this. Anyways, thanks for tuning in. This is StockerFinance. I'm your host, David Scheuer, and I'll see you guys in future videos. Peace out.